nothing can actually describe what 2008 was like. Index was down, I think, nearly 65%. Let's say somebody had 1 crore has now 10 lakhs. It was probably the hardest time of my life professionally.
On today's episode, we have Sandeep Jethwani, the man who manages wealth for some of India's richest people. After surviving the 2008 financial crisis, Sandeep took his nearly 2 decades of experience as a wealth manager and went on to build Dezerv, a wealth tech company with a twist. With 11,000 crores in total investments today, Dezerv's journey is truly unique. In this episode, Sandeep shares stories of the bizarre world after the 2008 crisis. He breaks down India's wealth ecosystem and shares insights behind building Dezerv brick by brick. I think we were talking about zooming out a lot, and we were talking a lot about your childhood and where it all started. So yeah, I think let's get to that.
Actually, like most Sindhis, my family, my grandparents actually moved to what is India from what was earlier undivided India, part of Pakistan now. And when you move countries or when you move and leave all your sort of wealth and life behind, you start at the bottom of the economic strata. So they lived in a refugee camp, and that's where my dad especially grew up. Some of that stays with you through the rest of your life. So in how hard they worked or how they thought about money, the remnants of the fact that money can be scarce, life can be difficult, were very, very prevalent, and we could feel that on a daily basis. I was born in Nagpur until about 1992. We moved to Bombay in September of 1992. Nagpur was a very easy existence. You would do well in school, competition was low, etc. You come to Bombay, here is a city which is, everyone is going for it. Even kids are more like ambitious, want to study really hard. Academic pressure is high. I was always very interested in this whole business aspect of things, like especially around money, because the Ketan Parekh scam had happened. So there was this, it was a part of the zeitgeist. There were discussions around, why have stocks fallen? What is this? Why is this man going to jail? What is going on? And so on. So it was very interesting. And when I spoke to a bunch of folks, it seemed very clear that an IIM degree or an MBA degree will help me get to that point. 2003 got into IIM Bangalore.
Yeah, I think let's get into the career bit. Which was the first company you went to after college?
Kotak Bank. And this was a time when Kotak was just becoming a bank. Actually, Kotak used to be a brokerage, and I'm that old. So Kotak used to be a brokerage NBFC. Kotak Securities were there. They used to do all this vehicle finance and so on. And they had just become a bank. And wealth management was becoming a thing at the bank. 2004 is when the elections had happened, when unexpectedly the Vajpayee government had fallen, and then a coalition government led by Manmohan Singh was put together. Markets were doing crazily well, right? Look, so every month markets would go up a few percentage points. Whatever recommendation we would give to clients to invest in would make a lot of money. We were walking 6 feet in the air as wealth managers. We know this better than the people who make the money. And this was in the run up to 2008. So 2004, 5, 6, 7, 8, even in the US was this whole boom that was going on. So it was a fantastic time to enter the industry. Like wealth management was a very, very glamorous business, right? A, it was easy to make money for clients. B, clients were really looking up to you. C, there was this money sloshing around even in the industry, and therefore every wealth manager had a very good life.
But what happened after Kotak? Where did you?
The markets were on a tear. Everyone was making money, right? And a group of us, led by one of the seniors at that time who I was working with, decided that it's time we made that money for ourselves and not for Mr. Kotak, right? So we should start up on our own. October, November 2007, when these conversations were going on. And at that time, I felt like I have nothing to lose, right? And we were feeling invincible as wealth managers anyway. And almost in the first conversation that he had with me, I was like, yeah, I'm in. Tell me when. On around 30th of December 2007 is when we decided that we will resign from Kotak. And 3 months later, we will start a new organization. Early 2007 is when conversations started happening, which with a company which was then called India Infoline, now called IIFL, and they were looking to get into wealth management. We were a good team, and we found a lot of synergy in working together because the licenses would be easier to get. There would be some capital. There's a infrastructure of running a company which is already there. So we decided to create what became IIFL Wealth in April of 2008.
I think want to get a sense of 2008. What was breaking in India? I'm sure it must have matched your IIFL journey. So wherever it fits, but want to go very deep into 2008.
Harsh, nothing can actually describe what 2008 was like. 22nd of January 2008, I think, was the first deep correction that happened in the market. It was a fantastic time in the capital markets. And suddenly one day, markets just fall. Now, in hindsight, it was not so sudden. Things were bubbling in the US with the credit crisis. Then there was a period of stability. And then again, in a later part of the year, markets collapsed again. So just for context, and I might be off by a few percentage points, I think Kotak stock fell 90%. The company that we were working for, IIFL Wealth, IIFL Holdings, the stock fell 95%. Now, these are very hard numbers to digest, right? Because now these are percentage points, but the moment you put it in context, let's say somebody had 1 crore has now 10 lakhs. The index was down, I think, nearly 65%. So there were some very intense conversations. It was probably the hardest time of my life professionally.
Very interesting. So this was your first year at IIFL?
First year starting the company. And I remember like us getting together in end of 2008 and saying ki, let's give it 3 more years. फिर reassess करेंगे. अभी reassess नहीं करेंगे. We all took salary cuts in early 2009.
How do you bounce back from something like this? And what was that period looking like? Like what were the early signs ki, okay, we might make it through. This is not we're not falling off the bottom. What was the recovery phase like and how long did it go for at least?
2009 actually got even more interesting. We thought that it was hard for us as a new wealth management company. What we realized, it was much harder for the larger wealth management guys. At that time, there were a lot of these global wealth managers who were operating in India. They decided that India is a minuscule part of their business and I'll shut shop and send the team back. Marquee names like Merrill Lynch, SocGen, etc. decided to either scale down or shut down the India businesses. Now, this almost came like a gift from heaven for us, right? Because here we were, new wealth manager, little baggage, the existing players are vacating the space, and there was this vacuum getting created. Clients were wondering, whom should I talk to for my wealth, right? And we sort of were bang in the middle, front and center. And we said, here we are a bunch of smart kids from relatively good institutions. We know how to do this. We have also learned the hard way. We will work with you on your portfolio. We will course correct. And that, I think, became the reason for our success. The second mega trend which started playing out at that time was that a lot of business owners realized in 2008 that businesses can go up, but they also can go down. So in 2009 and 10, when the bounce back started happening, a lot of them said, let me liquidate at least a part of my business and secure myself. Because I don't want to live through 2008 again. So if, let's say, my business is worth 100 crores, let me sell 20 crores worth of my company and secure my family so that they are not looking over their shoulder. And that created this whole sort of series of liquidity events that started happening. And they needed somebody to manage the liquidity for them. So both of these two trends almost converged, where old legacy wealth managers exited India and suddenly people had new fresh cash to invest.
What were like the initial days of Dezerv? And tell us also a lot about the kind of research that you were doing.
Harsh, in most cases, in most big life decisions, it's the instinct above data, invariably, like at least for me, right? So the fact that there are people like me don't have a good wealth manager was very clear, right? And I wanted to solve that. And when we would even prospective clients or people in the ICP would talk to us, we would hear what we wanted to hear. That's what happened, and that sort of solidified the conviction that there is something here that we can build.
I think let's talk about this user insight. These are the first generation of wealth creators, and they don't really have a trusted source or somebody really solving for their portfolio and the way they think through money. But wealth managers have always existed. They've always existed in the traditional banking sense as well. I'm sure you must have thought of that current traditional wealth managers who exist. What was like the insight there? For example, what could you do very differently that didn't happen? Was this such a big problem that, hey, maybe they exist, but the guidance that they're giving is not enough? Like, what was the real problem that you identified on the wealth management side?
The requirement of the new wealth creator was very different, right? I'll give you an example of, let's say, a recent case. Swiggy went public. Somebody who's sitting on, let's say, 5 crores worth of Swiggy stock, what is your recommendation to them? Should they hold? Should they sell? Should they exercise the stock? Should they not exercise the stock? And most wealth managers had built this muscle of advising the second, third generation wealth owner who would already have money and guiding them on, abhi fixed income karna hai, equity karna hai, mutual fund mein kare, AIF mein dale, all of that discussion. But this guy, the Swiggy CXO, has nobody telling him what to do. And there's new ways of wealth creation that were happening, which the traditional wealth management industry had never engaged with. Secondly, the traditional wealth manager would educate the client about different financial instruments. Our client already knew about. So they're starting from a much higher degree of awareness, and their expectation of value from you is way, way higher. But I think the core insight and the core difference is in how, as wealth managers, do we take ownership or we do not take ownership. At Dezerv, we are portfolio managers to India's wealth creators. We will manage, take full responsibility, change, churn, rebalance, tell you when to come in, tell you when to exit with conviction, and we will take full responsibility of the consequences of that. In traditional wealth management, what happens is, here is an idea. I'm going to send you a menu card of 5 ideas. Aap decide kariye. If I was a layman, if I'm a 20-year-old who has no knowledge about wealth management, wealth tech, what does the landscape look like? And treat me like a kid who's extremely curious, but wants to know everything about the wealth ecosystem, for example. Just up top, to be a prospect for a wealth manager or to be a potential client of a wealth manager, you need to have wealth, right? And the moment you have money, okay, think about it like a spectrum. On one side is the saver. A saver is somebody who will probably leave their money in the bank account. In the middle, there is an investor, somebody who is trying to figure out how to make the money grow. And on the other side, there is the trader who wants to make return, but also the process or the experience of churning the portfolio is as important to them as the returns they get out of it. So it's almost like 3 groups of people. The banks primarily serve the saver. What will they encourage you? They will encourage you to keep the money in the bank account. The second category of investors or second category of wealth owners is the investor. Now, this investor is trying to look for better return. The moment first time you have money, you want to invest it yourself. You want to figure out how to do this, right? And that's always the way it should be. First, you should experiment with investing in a mutual fund yourself. You should experiment with putting into stocks yourself, find the right FD, find the right bonds, etc. As your wealth keeps growing and you go up the y-axis, you realize that now the stakes have become much higher. A wrong call will set me back by probably a year's worth of income, and therefore I need to structure it. This is the first time you start seeing people putting together Excel sheets of they'll put together a fire goal, they'll put together कि अच्छा इतना मेरे को बच्चे के education के लिए चाहिए, इतना मुझे घर के लिए चाहिए, etc. So that planning starts happening in the second. And the third level is when you realize that now the stakes are so large that I can't do it myself. So in this spectrum, the investor, and within the investor also the person who's tried investing themselves, tried structuring themselves, and now needs expert assistance to do it. That is the segment that Dezerv works for. The interesting thing is that it's almost like seems like all of the other segments eventually converge here, right? In large part. The saver becomes the investor. The investor then starts investing themselves, structuring themselves until the point that they need a wealth manager. The trader also, on the other hand, enjoys the process of trading, till such time as they become older. They have the job takes more out of them, the family takes more out of them. They do not have the time. And by the way, like SEBI told us, maybe 90% of traders are actually losing money. So it's almost that apex position that the investor who takes professional wealth management, that becomes the place that everyone ends up at.
Your life cycle is very interesting, that at least the way, and tell me if I'm wrong, which is the initial bit is maybe somebody starting with like a Zerodha or a Grow and they invest by themselves. That happens for a while. These people are also very interested in 2FDs. So people like stable money come in. These people are also aware about bonds, wind stable, fixed return products. I'm sure once all of this khichdi has happened in somebody's life, they come to you and maybe like give us an example of something that has happened here and what does a life cycle look like, and is this life cycle correct?
Okay, you're now talking about a person who's sort of very connected with the wealth tech or the app-based investing. But let's take a step back and look at somebody who's not got exposure to that. That person started their job at a company. The company said, open your account with Bank X. They opened the account with Bank X. Bank X RM came and sold them some products. They moved to another company and Bank Y was their new salary account. So they've now got some investments with Bank Y. Then their CA called them and said, look, I have this friend who does a good job of investing. Will you talk to him? And you say yes. And you then invest with that friend, right? Suddenly you have money in 3 different places. Then comes 2021, where you're sitting at home and you open an app and set up an account and start investing. So suddenly you have this raita of investments. Now this number runs into a few crores after a point of time. And then you do a double take and take a step back and say, now I'm not even able to see this in one place. How will this work? And Wealth Monitor was just that. We said, we will give you a view on your portfolio. Again, we had certain constraints that we put our team into. We said, we will not force the user to do manual entry of data, because then the user might end up punching in the wrong data and get wrong insights. And I would rather give limited insights to them on their portfolio rather than giving them wrong insights on the portfolio. I will do much more damage. I will not get into their email. I will not scrape from their email and read that. So that was the core principles. The interesting thing was the account aggregator ecosystem in India as a part of our digital public infrastructure was evolving at this time. And that enabled us to securely take user consent and fetch data and show it to the user.
I think final 2 questions. One is, want to double click a lot on how do you make money? Because for example, you don't have management fees, I think, and you have a profit share. Not sure if that's correct, but yeah, what does that look like?
So we operate under 2 models, and we leave this decision we leave to the clients because it is something that directly affects the relationship between them and us, is how they want to pay us fee. There are clients who choose to pay us a share of profit, and there are clients who choose to pay us a fixed fee. Over time, both of these mean revert, and broadly it's the same.
Would love for you to share stories of failures or stories where you didn't think it would work out. It could be with Dezerv, it could be in your professional life. For example, if a new founder is watching it, wanting to build in this space, what should they look out for?
We were used to managing at one time tens of thousands of crores, and suddenly you go back to zero and start afresh. And you think that people should trust me and give me money to manage and so on. But people interrogating, and they should. Why should I put 50,000 rupees with you? And that process today, in hindsight, I can romanticize as being client engagement and the best form of payback, etc. But on those days, every single day, after those 9 to 10 calls that you've done with prospective clients, out of which maybe one has agreed to put in money with you, it is incredibly hard, right? And I think in trust-based businesses, just getting it off the ground is just so difficult. And it just takes the emotional toll on you, and not only on you, your relationships, your friendships. Your friends won't see you for a long time. Your family doesn't see you. So I think in businesses which are not like this typical consumer business where you give a sort of incentive and immediately you have volume, our businesses are about the long grind on a daily basis, which is easy to romanticize but very hard to live.